It's actually fairly rare to find a company that has a market returning yield, but does have a bit of upside in the stock price as well. Typically, we see these high yielders, they really only grow by 1% to 2% every year while providing a much higher dividend yield. But this company has the potential to provide both, and it yields around 7.5% at the time of me filming this video. In this bull versus bear case, I'm going to be going over ALARIS Equity Partners, which is a company you might have never heard of before, but is actually one of the better operated small caps in the country. And it gives you a lot of exposure to something like the private equity markets, but as a publicly traded entity. And it provides an outstanding dividend yield and has actually gone on quite a bit of a run over the last 3 or 4 years in terms of total returns. So I'm going to dive into the bull case, the bear case, and my overall thoughts on this company. But before that, if you want my top 4 holdings, my allocations, my thesis, my risks, my overall outlook on these companies, head down below to the description. There is a link down there. It is absolutely free and just takes seconds to get. And as always, like the video, subscribe to the channel, comment down below. Let me know what stock you want me to go over next. A lot of these videos are based solely off what you want as a watcher. But let's get right into ALARIS. What exactly does this company do? Well, it is effectively a private equity firm that is publicly traded. So what it will do is provide financing to U.S. mid-sized businesses in exchange for distribution. So the one difference between private equity and something like ALARIS is private equity, you typically have an equity stake in the company and you realize profits when you sell that equity later on. ALARIS simply provides financing for these companies, and in turn, they pay ALARIS distributions in which it returns back to its shareholders. So while private equity typically takes a position in the company themselves, ALARIS is kind of a behind-the-scenes silent partner, you could say, which is good in some instances and bad in another, and I'll get to that in the bear case. This is one of the most important things about the company itself, so you're going to want to stick around until then. But another added element here is the company's payments are typically variable, meaning the success of its partners is typically the success of ALARIS. It doesn't just have a set distribution it gets when it does financing to these companies. Typically, if their EBITDA, their margins, their revenue continue to grow, ALARIS's distributions grow. So pretty much in a nutshell, if you're buying ALARIS, you are buying exposure to 20 to 25 mid-sized businesses in the United States, primarily in the servicing industry. The company is very well diversified, but you're going to see a lot of things like plumbing companies, HVAC companies, plastic surgery companies, rebar manufacturers, things like that. It's pretty easy to dig into this company's overall portfolio of companies. In fact, I'll just throw one up on the screen here so that you can have a look. But you're just providing financing as a shareholder to a lot of mid-sized U.S. businesses that are not publicly traded. So the bull case, and this is going to be a huge deal for dividend investors, is the distribution is well covered. So the company typically hovers around a 60 to 65% distributable cash flow payout ratio. And with this company, you're not really going to see a ton of dividend growth. It has grown the dividend every single year since it's restructured from a corporation to an income trust. Don't trust a dividend growth chart pre-2020 from this company. It restructured as a different sort of entity, and since then it has grown the distribution every year, but you're only going to see tiny increases from this company because it does like to keep that earnings coverage ratio, the payout ratio, in the 60 to 65% range. With the company yielding 7.5%, I would argue you don't need a ton of dividend growth either. You'd much rather this company utilize those cash flows to acquire more partnerships. Second bull case, one of the main differences between something like a private equity firm and ALARIS is the fact that private equity typically takes a lot of positions in fast-growing startups. Maybe they're not necessarily profitable. They need a lot of funding. ALARIS's portfolio of clients, they are very mature businesses in the U.S., often operating 25 plus years or more. They have growing earnings. They're profitable. They're often cash flowing, mature companies. So they're a bit more steady than a equity-based investment in a startup. So again, diversity is another element here. The company's partners are very diverse. I mean, like I had mentioned, we do have a lot in the services industry, but the thing is, a plumbing company and a plastic surgery company are very, very different. Yes, they're both technically services offered to American consumers, but they tend to have different impacts based on the economy. But this company does have a very diverse basket of partners, which should help offset particular issues in the economy. And I'll get to one particular in the bear case as well. So, I mean, again, this company opens up a pretty unique way to invest. If you think about it, it's relatively hard for an individual investor to get exposure to these types of companies unless it is a private equity or a private debt situation. But ALARIS, you get exposure to all of this through a publicly traded liquid entity, those rebar companies, the plumbing companies, things like that. It's very hard for you to go out and get exposure to this on the open market. So it does provide that unique exposure, and it's probably one of the only companies in Canada that does so. Then again, that final situation is a private equity firm. They have to buy the equity, and then eventually they have to look for an exit. ALARIS just provides financing to these companies, and it gets paid on day one of that financing. So if the company butchers the operations with a private equity firm, likely that equity position is lost and it's pretty much a write-off for the company. Whereas ALARIS, they're getting paid those distributions on a monthly basis, and they can recoup some of that money if the operations were to go sour and ALARIS was not able to recoup its initial financing. It would still get paid at least something. So that rolls nicely into the bear case here, which is the fact that ALARIS has no control over these companies. So private equity firm, they will have a say. They will have voting rights on the shares. ALARIS does not. They issue that financing. They're a silent partner. If the company, in theory, butchers the operations, the company has a decline in revenue, profitability, things like that, ALARIS's distributions will obviously take a hit, and they don't really have any control in trying to recoup the operations of that company. This is a big risk for shareholders of ALARIS, and it's something you really do need to know. Second bear case is concentration, and I'm not talking about sector concentration. I'm more so talking about partner concentration. So the company only has 24 or so partners. So if one partner gets into trouble, it does have a pretty big impact on results. And this happened, I believe it was back in 2022 with the company LMS Steel. This is that rebar company that they were dealing with. The price of steel skyrocketed, and LMS effectively had to make rebar with skyrocketing steel prices, which effectively their margins just got toasted. They were reporting a loss in terms of overall profitability. So they couldn't pay the distributions to ALARIS. That ultimately impacted ALARIS's distributable cash flow. And yes, they can survive the loss of one client, but it no doubt has an impact on results, and it's going to spook a lot of shareholders as well. Now, LMS has got back to paying all of its distributions. It's back in terms of profitability. It paid back all of the old distributions that it had missed. So it's back on track, but this is a risk for the company. Some of its partners make up a double-digit percentage of its overall cash flows. So another element here, and is one that probably a lot of people ignore, is currency risk. So this is a Canadian traded company, but the vast majority of its operations are in the United States. So the strengthening of the Canadian dollar does have a detriment to its earnings. We saw this in 2025. Through the first 6 months of the year, the company has realized almost $50 million in losses, not losses in general, but just those foreign exchange losses because of the fluctuations in the Canadian dollar strengthening versus the US dollar. So this is going to be a big impact, and large currency fluctuations, especially the Canadian dollar rising versus the US dollar, is generally not a good thing for ALARIS. We want to see a weaker Canadian dollar. Overall, I think this is actually a pretty high quality company that provides income to a lot of investors who want income, but it does have that extra element of potential growth in its current share price. So I used to own ALARIS, and what I ended up doing is, once the company got back to its 5-year historical valuations in terms of price to book, which is in the high 0.8 range, I actually ended up selling the company. And fast forward till now, this looks to be the right case because ALARIS has now gone through a bit of a dip and is now trading at around 0.77x book value. So I have debated re-entering to take advantage of the discounted valuation yet again. Now, I bought previously when ALARIS, I believe it was back in 2023, when ALARIS was very, very cheap. And I did realize quite a bit of upside from this purchase. I don't think you're getting that huge explosive upside anymore, but the 7.5% dividend yield with, a double-digit discount to historical valuations in terms of a price-to-book basis, it definitely does make the company, a little bit more attractive. For me to buy, there would likely need to be a bit more of a drawdown because I don't really care much about that dividend yield. What I do want is higher total returns, and I think if the company does get any more discounted from here, it will present another opportunity in terms of larger outsized gains on a total return basis. But if you're an income investor, this company is relatively cheap, and it does provide a market returning yield with a bit of upside here. So I can definitely see the attractiveness from this case. It's just important that you understand the business model, the risks. This is a fairly complex company on the surface, but I hope this video did help you kind of navigate what it's all about. And it's a relatively simple business model. You just got to do a little bit of digging. So everybody, that's it for the video. Head down below, like the video, subscribe to the channel, comment. Let me know if you like ALARIS, if you love the dividend yield, if you love the company overall, and let me know what companies you want me to go over next. And as always, there is those reports in the descriptions with the top 4 holdings of my portfolio revealed. You can grab that absolutely free. Just takes a few seconds, and we'll see you next time for more great Canadian content.